Happy Friday, Eric Bible with the Bible team at Neil Home Loans. It's Friday. Yes, rates are up, but there is some silver lining. But the big thing I want to talk today about is winning with contingent buyers. And no, it's not an expensive bridge loan. So more to come on that. But first, let's unpack interest rates, what's happened this week, and ultimately where we are today and where we see things going from there. As I reported last week, we got an unfavorable jobs report. 30-year fix felt pressure starting Friday. Friday ended up being one of the largest moves since March of 2020 in interest rate, not in our favor. However, since then, we've seen a gradual pullback. At the beginning of this week, 30-year fix did break 7%. This morning, I'm happy to report that it's sitting at 6.95. So let's understand why. The Fed, as we know, did not hike interest rates. And last month, January 31st to be exact, Jerome Powell took the podium and indicated that the Federal Reserve is not expected to hike again, and the next move in interest rates will be down. Now, he was very clear and direct to state, we are likely not going to see that in March, but we are expected to see them sometime in 2024. And why, coupled with the jobs report missed last week, why we've seen rates kind of retrace is, I believe, and the market does as well, the market got a little ahead of itself. There were reports throwing around that we were expecting to see 6, 7, possibly 8 rate cuts in 2024. And Jerome Powell came out and said, look, I think you all got a little overzealous and have expected us to cut rates at a much faster rate than we are forecasting at this point. Yes, inflation has come down. You look at the 6th, the 8th, and now approaching the 12-month trend, we're in line with the 2% target that the Fed has mandated. However, employment has been the very, very sticky piece. Employment has been strong. We saw unemployment hold firm at 3.7% and a headline number of new jobs creation of 353,000 over the 180 estimated. Yes, there are questions around the integrity of the data collected, the number of layoffs that are forthcoming. But at the end of the day, the markets react based on real-time data. That said, the economy from the labor sector is still strong until we see weakness in that labor market, which can come on very abruptly. We're going to see some volatility in interest rate. Good news, though, is that activity is picking up. We're seeing more buyers and sellers enter the market than we've seen in the last year. Week over week, since December, mortgage applications for both purchase and refinances have consistently risen. We've seen new inventory come online. Yes, it's not the inventory we want. Trust me, I know it. But we are seeing more activity, and the engagement from the consumer is better. We're seeing more excitement from buyers, eagerness, wishing to get into the market, wanting to get into the market, you name it. And it comes around this mantra that the expectation and now supporting evidence behind it is that interest rates will fall. We don't know when, we don't know by how much, but the consensus across the board is that interest rates are too high and they need to come down. With that, home prices have remained very strong. So strong to the point where last week I reported that CoreLogic, Case-Shiller all reported some of the all-time highs in home appreciation. And again, that's on the backs of multi-decade high interest rates. Our consumers are catching on. With that, we're seeing a resurgence of individuals that want to enter market, but they have to sell their house first. And we all know, we've all taken that phone call. Mr. or Mrs. Realtor, I'm so excited. We found the perfect home. We need to upgrade because the bedrooms are the current house is too small. We don't have enough rooms. It's not in the school district. We want, the list goes on. We found the perfect house. We want to write an offer. The excitement boils. Everything is there. But then they drop on you. We absolutely need to sell before we buy. The kiss of death. You know, I know in this market, getting a contingent offer, whether you're in San Diego County or Coeur d'Alene, Idaho, or you fill in the blank, it's near impossible. So, how do we combat that? Undoubtedly, yes, the client has to sell, but we all know getting that offer accepted contingent is a struggle. Most commonly, people will look to bridge loans, which bridge loans, they're great. We do them. They are very expensive. Tens, if not hundreds of thousands of dollars in added cost and interest. Typically not the best solution for the client. We've identified a very cost-effective approach that is winning, putting deals in escrow and helping clients buy before they sell at a fraction of the cost. This is traditional financing. Obviously, yes, the client has to approve for this. They have to be qualified to go down this route. But I can tell you it is working and it is being well received in market. We just closed one last week where they did not have a chance if they were going to go on contingent. They beat out 13 other offers in Carlsbad, California, and are selling their home after they move into their new property. If you want to know more, get time on my calendar. I would love to share how we're winning with contingent buyers in this market. I'm here and available and look forward to speaking with you. With that, make it a fantastic Friday and an even greater weekend. Thank you.